A $5 cotton t-shirt defies the fundamental laws of agricultural production, manufacturing labor, and global logistics. To bring that single garment from a cotton field in India to a retail shelf in London requires a complex choreography of harvesting, spinning, weaving, dyeing, cutting, sewing, and transoceanic shipping. Yet, the final product is priced lower than a cup of coffee. This is not a miracle of modern industrial efficiency, but a symptom of a highly engineered financial architecture. The modern apparel industry operates on a vast system of hidden subsidies, where the true costs of production are systematically deferred, externalized, and pushed deep into the shadows of the global economy. The phenomenon, universally recognized as fast fashion, relies on a fundamental restructuring of consumer behavior and corporate financial incentives. For decades, the clothing industry operated on a predictable two-season calendar, dictated by agricultural harvest cycles and steady manufacturing lead times. Today, that timeline has entirely collapsed. Major multinational retailers now inject thousands of new styles into the market on a weekly basis, creating a continuous, artificial scarcity of trends. This relentless pace demands a highly elastic manufacturing network, one capable of turning a digital design sketch into a finished physical product on a rack in under 15 days. At the core of this acceleration is a strategy originally perfected by the technology sector, known as planned obsolescence. However, instead of engineering a battery to fail after 2 years, apparel conglomerates engineer aesthetic and structural expiration. By deliberately degrading the physical quality of the textiles and rapidly cycling the cultural relevance of the designs, the system forces continuous, cyclical consumerism. The primary product is no longer the clothing itself, but the transient experience of novelty. This paradigm shifts the economic engine from capturing value through long-term durability to extracting massive volume through high-frequency transactions. The genesis of this volume-driven model traces back to a pivotal shift in global trade policy during the late 20th century when international agreements began dismantling protective quotas on textile imports. As regulatory frameworks that had long governed the flow of garments between developed and developing nations were gradually phased out, a seismic migration of manufacturing capital occurred. Western brands realized that owning physical factories and directly employing domestic workers carried immense financial drag and severe regulatory burdens. The strategic corporate response was rapid, mass divestment of physical production assets. By severing the tangible assets of production from the brand identity, corporations achieved unprecedented financial agility. They effectively transformed from traditional manufacturers into sophisticated marketing, data, and logistics firms. This asset-light model allowed them to pit developing nations against one another in a brutal, continuous competition for manufacturing contracts. When a brand does not own the factory, it does not bear the legal liability for the conditions inside it. The power dynamic shifted entirely to the corporate buyer, who could now demand aggressively lower prices and faster turnaround times, wielding the constant existential threat of moving their lucrative contracts to a cheaper, less regulated jurisdiction. This structural leverage birthed the modern, hyper-fragmented global supply chain. To meet the crushing margin demands of Western brands, primary suppliers routinely outsource their massive orders to secondary and tertiary facilities to keep costs artificially low. This shadow network of unauthorized subcontracting operates entirely off the books, deliberately positioned beyond the reach of corporate auditors, international watchdogs, or local labor inspectors. It is precisely within these hidden, unregulated tiers that the financial margins required to produce a $5 garment are actually forged. The stark economic reality of this shadow network relies entirely on severe labor exploitation. In regions where minimum wage laws are either non-existent or intentionally weakly enforced to attract foreign investment, the suppression of labor costs becomes the primary mechanism for maintaining corporate profitability. Workers are frequently subjected to piece rate compensation models, where they are paid mere pennies per garment completed rather than a reliable, living hourly wage. This specific incentive structure forces extreme, unregulated working hours, transforming human endurance into a highly elastic commodity designed to absorb the shock of volatile retail demands. The consequences of this relentless margin compression occasionally break through the carefully constructed veil of corporate plausible deniability. Factory collapses and catastrophic industrial fires in major manufacturing hubs are not unpredictable tragedies, but the statistical inevitabilities of a system that systematically starves its own infrastructure of capital. When a supply chain is optimized exclusively for maximum speed and minimum cost, fundamental safety protocols and structural integrity become prohibitive expenses. The financial risk is effectively transferred from the corporate balance sheet directly onto the physical bodies of the global workforce. Yet, human capital is only one side of the hidden economic ledger. The other is the massive, compounding ecological debt accrued by the industry. In macroeconomic terms, this is a textbook example of a negative externality, a severe cost generated by a commercial transaction that is borne by an unconsenting third party, which in this case is the global ecosystem. Because the retail price of a fast fashion garment does not include the cost of the environmental degradation required to produce it, the clothes are artificially too cheap, leading directly to massive, unchecked overconsumption. The sheer volume of raw materials required to sustain this hyperconsumption represents a liquidation of natural capital on a planetary scale. Cotton cultivation, a deeply water-intensive process, rapidly drains ancient aquifers and degrades soil health in regions already highly vulnerable to severe drought. Furthermore, the industry's aggressive transition to synthetic fibers has tethered apparel production directly to petrochemical extraction. These fossil fuel-derived fabrics are essentially spun plastic, incredibly cheap to produce at scale, but carrying an immense, entirely unpriced carbon footprint. This environmental impact severely accelerates during the complex manufacturing phase. The industrial dyeing and finishing of textiles require sophisticated chemical cocktails, heavily reliant on heavy metals, toxic solvents, and synthetic fixatives. In manufacturing hubs deliberately chosen for their lack of stringent environmental regulations or costly wastewater treatment infrastructure, these toxic chemicals are routinely discharged directly into local river systems. The catastrophic ecological cost is highly localized, poisoning vital agricultural land and municipal water supplies, while the economic benefit is cleanly exported to retail centers in the global north. The final phase of this linear economic model is disposal, where the illusion of cheap clothing violently collides with physical reality. Because the garments are explicitly designed for planned obsolescence, their functional lifespan is drastically truncated. The resulting waste stream is unprecedented in human commercial history. Millions of tons of discarded textiles are exported annually from wealthy nations to developing countries, ostensibly moving under the guise of charitable donation or secondary market recycling. However, the global recycling infrastructure is entirely incapable of processing this overwhelming volume, particularly given the complex, inseparable blends of synthetic and natural fibers used in modern garment construction. The secondary market for used clothing has thoroughly collapsed under the crushing weight of structural oversupply. Consequently, these discarded garments end up choking massive, unregulated landfills or are openly incinerated, releasing highly toxic microplastics and concentrated greenhouse gases directly into the atmosphere. The developing world is thus forced to financially and ecologically subsidize the disposal costs of Western consumerism. This dynamic creates a profound, systemic macroeconomic distortion that masks the true cost of production. The actual price of a fast fashion garment includes the agricultural subsidies for water-intensive cotton, the externalized healthcare costs of an exploited labor force, the massive environmental remediation of poisoned waterways, and the municipal burden of endless waste management. If these profound external factors were forced to be internalized and accurately reflected in the retail price, the entire business model would instantly collapse. The industry's soaring profitability is entirely dependent on its ability to keep these immense costs completely off its own balance sheet. The global financial markets, however, aggressively reward this systemic externalization. Apparel conglomerates that successfully push operational risk and environmental cost onto their vulnerable suppliers report significantly higher profit margins and stronger quarterly earnings. Institutional investors and high-frequency algorithmic trading systems respond to these positive financial metrics, driving up corporate stock prices and reinforcing the underlying incentive structure. The architecture of global finance effectively demands the continuation of these exploitative practices, severely penalizing any brand that attempts to internalize its true costs and raise prices to sustainable levels. Attempts to regulate this sprawling, transnational matrix have historically been outmaneuvered by sheer corporate agility. When one sovereign nation implements stricter labor protections or robust environmental laws, the supply chain simply reroutes its capital flow to a more permissive, deregulated jurisdiction. This phenomenon of regulatory arbitrage ensures that the global race to the bottom continues entirely uninterrupted. Voluntary corporate social responsibility initiatives often serve as little more than sophisticated reputational risk management, completely failing to address the core economic incentives driving the systemic harm. The fundamental, unyielding issue lies in the required velocity of capital. Fast fashion has meticulously conditioned the global consumer market to expect infinite aesthetic variety at continuously deflationary prices. This engineered expectation creates a rigid, unforgiving demand curve that leaves global suppliers with absolutely no financial margin for error, safety, or ethical improvement. To alter this destructive trajectory requires a massive deceleration of the entire economic mechanism, forcing a complex shift from linear resource extraction to a genuinely circular model of utilization. Such a systemic transition threatens the foundational, profit-generating premise of volume-based retail. If garments are designed for long-term durability, repairability, and genuine recycling, the frequency of consumer purchases will inevitably and sharply decline. This represents an existential threat to the aggressive quarterly growth targets demanded by publicly traded apparel giants. The corporate resistance to systemic change is not merely a lack of technological innovation, but a highly rational, fiercely guarded defense of a lucrative, albeit fundamentally unsustainable, financial paradigm. The ultimate reckoning of this complex economic matrix extends far beyond the realm of retail clothing. The hidden economic costs of fast fashion are quietly accumulating as a massive, unacknowledged debt on the global balance sheet. It is a profound debt measured in permanently depleted aquifers, economically marginalized populations, and overflowing toxic landfills. The invisible forces that built this industry have achieved unprecedented, ruthless efficiency in manufacturing desire and delivering temporary satisfaction. But they have done so by systematically mortgaging the ecological stability and economic future of the planet.